Hey, everybody. Happy Thursday, April 8th. John Gibson, SVP at TPO Lending over here at Flagstar. Welcome to our next edition of our Flex series. I'm excited about our guest speaker today. Before we get started, though, I want to say, hopefully, again, as always, everybody's doing well, healthy, safe. Obviously, vaccines are being distributed. Obviously, it's a personal choice on whether or not you're going to get that or not, or receive it. But hopefully, in your areas, you're able to take advantage of that if that's of your choice. And more importantly, hopefully, this just finds you all doing well, like I said earlier, healthy and safe. Crazy to believe we're already in April. Hopefully, you ended your first quarter strong as the month ended last week, I should say, and got into a holiday weekend, and hopefully that your April has started off strong, right? So really solid first quarter in comparison to other years in our industry, and obviously our guest will have some insight and share some thoughts with us on all things from a housing perspective and economy. So let's get right into it. I wanted to introduce, before I bring them out, I wanted to give you a little background on our speaker today. So we are very fortunate to have Logan Mohtashami from, it says on there, lead analyst for HousingWire, which he is, but Logan does much, much more. So he is a housing data analyst, financial writer, blogger, covering the U.S. economy with a specialization in the housing market, which is why I'm so excited to have him today, because I think he's going to share some really good insights with us as we strategize for the rest of 2021 and into the future. He also works frequently and is quoted on bankrate.com, Bloomberg Financial, and he's been invited to speak at many conferences throughout his tenure in this industry. Some of those being the California Association of Realtors, the National Association of Women Real Estate Business, and other economic conferences where he is in high demand. He is a recurring guest on Bloomberg Financial, where he discusses the health of the housing market. Perfect timing for him to be on with us today. And as I mentioned earlier, right, he's obviously a lead analyst for HousingWire. And prior to all that, he was like us, right? He was out on the street. He was a senior loan officer at AMC Lending Group. And he has been in the mortgage real estate industry, either doing loans or providing some type of service back in California, or to the residents of California, I should say, going all the way back to 1987. So with that being said, as you can tell, I'm really excited to have him here today. I'd like to welcome Logan to the stage.
Hi, it's great to be here.
Logan, how you doing, buddy?
I'm doing excellent.
So rumor has it you're a UCLA guy, right?
Oh, yeah. It has been a very fun, even though the ending didn't go as well, but it was one of the best tournaments ever. Actually, the best tournament, if you ask me. Better than the championship run that we had.
Yeah, they had a nice little run. We were talking about, right? A team can get hot, and when they do, look out in that tournament, right? So yeah. That must have been fun.
Yes, definitely a lot of fun.
So Logan, appreciate you being here. I think it's extremely timely, right? There's a lot going on in the marketplace. I don't want to say we're coming out of a pandemic, but we're coming out of a year unlike any of us have seen, and for the reason we saw it in a very long time. So I know there's a couple things that we were going to kind of talk about or address today. I'll throw one out to you just to get it started, and we can go from here. I think if you look at, I'm a big believer in trying to, stay educated, knowledgeable. I read a lot of different things, and I try to keep myself up to date on trends and things that are happening. But I mean, there's a lot of things I look at that if you look at 2020 through, 2024, people are predicting some of the best housing demographics we've seen in a very long time. What's kind of your thought on that from a standpoint of what that looks like?
So for me, always, economics done right is terribly boring. I always tell people, you want to be the detective. You don't want to be the troll. So a lot of my work in the past decade has been talking about that housing would have its weakest recovery from 2008 to 2019. That certain data metrics, for example, the purchase application index will never get to that 300 level until years 2020 to 2024. and housing starts will never start a year at 1.5 million until years 2020 to 2024. That means demand finally warrants it. So it was hard convincing people for a decade that this was going to happen, but 2020 came, right? And before COVID hit, the February existing home sales report, which we got in March, showed the first breakout in housing and went from an underperforming sector to, whoa, here we go. But when we got that report, it was right in the middle of the chaos that COVID-19 created for us. So for me, it was basically, okay, so you're going to have to create an economic model based on a pandemic, which of course it's going to be difficult. But if you believe in the fundamentals of economics, which is demographics and productivity, if you believe the fundamentals of housing economics, it's really demographics and mortgage rates. And then you have a conspiracy group of people, call them the housing bubble boys. How do you take them out and show that the US is going to recover in 2020, which a lot of people said there's no way. So last year for HousingWire, I wrote the AB America's Back economic model, certain data lines to track that were already recovering and dates to kind of connect the dots. And by 2020, by the end of 2020, the 10-year yield should be near 1%. And it'll be very evident that we're going to be out of the recession. Everything worked as planned. But there's one thing about years 2020 to 2024. When you have the best housing demographics ever recorded in history, and then the lowest mortgage rates ever recorded in history, and housing tenure is 10 years, where from 1985 to 2007, it was 5 years. The concern isn't a bubble boy 75% crash back to the 2012 levels. It's real home prices adjusting to inflation, the equivalence of rent can take off in a very unhealthy way. And that's what we're seeing. And it's a very difficult problem to solve when you have near 32.5 million Americans ages 27 to 33 running into their first time home buyer age with mortgage rates this low. So we're in this situation where I look at housing as being stable. I'm not one of these housing boom sales kind of people. I think, to me, if new and existing homes together close the year above 6.2 million, you should look at it as a beat. But it also can create real home prices to take off. And everybody now understands it's different than what we saw from 2008 to 2019. And my job is to try to make sense of all this that's happening currently.
So if you're looking at that, like, what do you think, what are some of the things, if you wanted to elaborate even further, that would concern you going forward?
Well, for me, nominal home prices going above 4.6% every year, which really means about 23% in a 5-year time frame. This year's 2020 to 24. If this starts to escalate, it's not a good thing. This is why I say this is the most unhealthiest housing market in the last 10 years. It's kind of like a first world problem because your fellow Americans make more money than you. They have more financial assets. They're outbidding you. That's great. The U.S. economy is great. You can see this massive recovery in the data because we never were going into a recession in 2020 without COVID. It also creates, buyer stress, and we're at the point to where sellers, to a degree, especially those that are looking to find another place, are a little bit stressed too. That's not an unhealthy market when both those things are combined. But because I believe there's limits to how home sales can grow, higher mortgage rates should cool everything down. The days on market, from the recent report, went from 36 to 20 days. We need this to get back up to 28, 29, get some kind of breathing room so where people can function. Like I'd rather like the 2019 housing market, where days on market were 40 to 45 days. We had 6 million total home sales. We were coming off 5% mortgage rates. So that is more of a stable, because housing is the cost of shelter to your own capacity to own the debt. It's not an investment. A lot of the bad takes in housing bases on housing being an investment, or why would people buy homes if home prices are going to crash. These are professional grifters. These are one of the things I always say, that the housing bears in America, I condemn them as the worst talented Americans we've ever had. And why I say this is biblical and historical, and that's that you have two things that drive housing the best ever in our history: demographics and mortgage rates, right? Those two are colliding together, and people were talking about a 7% crash in a calendar year, a bubble boy crash. Not going to happen. So if you could just ignore those people and follow data, you get a better perspective out there. But again, economics done right, terribly boring.
Well, it's interesting, right? Because you touched on a couple of things, and I liken it to it's a different market, right? But when we bought our house that I live in here in Northern Virginia, I think it was like the 2000, well, what are we in 21? I think we've been here. My daughter's a freshman in college now, so I think we've been here 8 years. So go back to like 13, 14. And I say it was only similar from one aspect, right? There was just an incredible shortage of inventory. And I remember when we were looking at homes, I remember we literally put a bid as the first person walking through a home. And by the end of the day, there was 15 offers, escalation clauses, you name it, everything going out there. So in that regards, you're seeing that with a lack of inventory, which kind of goes to a couple points you were talking about.
Here's one aspect. I have never been a fan of the housing industry when they say there's no homes to buy. I've always looked at that as a marketing gimmick because it's easy to say after any report that comes out of this, there's no homes. So guess what? Sales are at pre-cycle highs and inventory is at all-time lows. There were homes to buy. But in 2013 and 14, which was actually a really important year, you can see real home prices were up 10%. Right. It was like, what? And even myself, I was like, whoa. We're nowhere near the demand for this. I call that a housing inventory hangover, right? Whenever you come off of a crash, there's always a dislocation. Like we see that in production in some of the manufacturers around the world. So there's a dislocation which could facilitate prices to go above what it should be. But what happened in 2013 is that the 10-year yield went from 1.6% to 3%. Mortgage rates went up 1 full percent. It cooled the market down. It didn't create negative home prices, but it cooled the market down, from 10% all the way down to like 2 or 3%. That's what we want. Okay, that we do not want 5 years of 10% home price growth year over year because it's sticky. It's very difficult to remove. Housing doesn't have the velocity, and some of the bad takes I've seen is people think housing is like trading stocks. People don't do that, right? They don't flip their homes like some investors might do that, but it's just not that kind of marketplace. So it's sticky when that inflation is in there, especially now post 2010. We have the best loan profiles ever in our history. And I say this as my family's been in banking since the late 1950s. So you cannot emphasize how good homeowners look right now because why? They have fixed low debt cost versus rising wages and nested equity, and their debt to income ratios or their payment levels versus their incomes as a percentage are at 4 decades low. Why? Because the majority of all consumer debt in America is mortgage debt. Now you've got, at least the majority of the country is under 3.5%. So they have fixed debt against rising wages. It's never looked this good. This is one of the reasons why forbearance was never going to be the problem that I call them the forbearance crash bros, right? They went from the housing bubble boys to, crash is going to happen in 2021. So let's give them the nickname I did last early in the crisis. We're going to call them the forbearance crash bros. And we're going to show people why this wasn't going to work. You got to show people the path to walk away because, again, economics done right is boring, but you can show people why people are wrong. And what happened is forbearance, which was never bigger than the shadow inventory in 2012, has come down almost in half by itself in the calendar recession year. Why? Because a lot of people took forbearance that probably didn't need it. That 2.54 million number is probably not even legit itself. And now the second wave of job gains are going to come. We're going to get all the jobs back that we lost to COVID. We're probably going to get 10 million job openings at some point because the United States of America is not only the biggest and most dynamic economy in the world, we have the advantage over China, Japan, Europe, because we have prime age labor force growth, right? We have millennials and Gen Z. Both of them combined are bigger than the total population of Japan. Those countries don't have that prime age labor force growth. So we have demand coming in that could replace the baby boomers. And I think that's a really key important point for the next 3 decades.
It's interesting you brought up forbearance, right? That was our last Flex series in March. Courtney Thompson, who's our SVP of default servicing, came on and kind of did a state of the union, right? As far as forbearance, the past, the present, the future. And I think there is this misconception, I'd love to get your opinion on it, that there's this, you kind of mentioned there's this impending doom coming. And I just don't see that as the case.
The housing bubble boys, which have been screaming for a crash since 2012, had the biggest whiff ever recorded in U.S. economic history last year. You went from a 70% crash in prices to the most outperforming economic sector in the world. How can people miss this so bad? These aren't data people. These are professional grifters. These real estate YouTube sites, oh my dear Lord. Like, I don't follow a lot of people on Twitter, but people were sending me these YouTube sites from these real estate investors. Like, what is this? This is absolute garbage. There's no way a functioning human being can actually think this way. If you look at them as grifters, then you go, whoa, they're just trying to sell you something. So what happened is that, from 2002 to 2005, the quality of debt, credit, so much of this country is based on credit, was not good. It created a home prices from 2002 to 2005 went above per capita income. The ability to sustain those sales were not valid. So guess what? When credit tightens on that format, you have these massive declines in sales. That started in 2005. It wasn't 2008. 2005, you started to see the decline. Then you had a debt leverage cycle. A lot of people didn't have nested equity. The cash out boom back then wasn't good quality wise. So what you had is the people that defaulted the most were actually the serial cash out refinancers. It wasn't actually the purchase market. So you had tons of things that weren't working for you. Now you have people with 30 to 40% equity, and people are talking about a foreclosure crisis. Like, it doesn't work that way. People just don't foreclose on their homes that they have equity. 38% of all homes in this country have no mortgage debt. So the grifting caught up to them because they're not housing people, they're not credit people, they're not data people. They had the biggest whip. So forbearance to me was like, okay, they're going to move the goalposts. So let's show people why. First of all, that number was never really legit, that near 5 million number. It started to go down quickly because people's like, well, I'm living again. Remember, in 6 weeks, housing started to recover. So the COVID-19, the so-called the Great Depression of our era, 6 weeks, basically the world or the U.S. economy started to recover. Why? Because it was an artificial low. Like, you want to talk about oversold conditions? That was the most oversold condition ever. In economic data that is usually sticky, just had a waterfall dive. So forbearance, people thought that, well, all these people are going to foreclose on their homes. The silver tsunami, the hedge fund tsunami, all whatever these made up things are, was all going to happen. And then what happened is forbearance. I said, watch, you forbearance crash bros are going to have a problem. These things are going to slowly go down. And now it's 2021. Forbearance is about 2.54. I'm pretty sure that's like half the number is actually legitimately stressed. And now the jobs are good. The last wave. Now, majority of the job loss were tied to renter financial profiles. If you look at the data, people that make over $60,000, they're already back from the pre-pandemic highs. And the average homeowner makes about $100,000. So you're already there. It's just going to lag. And that's one of the things I've emphasized with HousingWire for the last year. This data is going to lag, and it's not going to be that big event. So the great crash of 2020, these guys wanted seconds. So it's 2021. The time's running out. It's April, boy. You're going to need at least, and I have these fun little models for the bubble boys. They need about a 73% average decline in year-over-year purchase application data within the next like 7 to 8 weeks to warrant this massive crash in purchase application data has been positive year-over-year. You don't want to read too much into the year-over-year data anymore because the comps are just crazy. So you just ignore all year-over-year data, but it's just not going to happen. So I say, this is the biggest whiff in history from some of the most untalented Americans we've ever produced in this country.
Well, and it's, hey, it's interesting thoughts, interesting comments, right? And look, I will tell you, I think you're spot on a couple points, right? Obviously, there's a much different perspective as a homeowner when you have 30, 35, 40% equity in your house, right? You just don't walk away from that. Right.
No, and these are homeowners. They're not investors. The crash people are investors. So these people actually like their neighborhood. Their kids have friends in the neighborhood. Their kids go to school.
The school district that they're in. Yep.
They get their incomes back because they all qualified for the loan when they got it post 2010. Right. That's why I've always stressed this. We have the best loan profile. So whenever a recession happens, it's going to be fine. And then we had the chaos event of our lifetimes. Look, it's going to be okay, right? It's going to be, so people have to let go of these fanatical crash people and go back to being boring. Boring is sexy. I know it's not the greatest thing to read all the time, but if you just look at the data, you think, wow, these people are really crazy.
Well, look, yeah, the profile of the borrower, I think, is huge, right? To your point, post 2010, this isn't like there was the fog the mirror type of stuff, 20% down, no income, 25% no income, no asset. Then hell, it got up into the much lower LTVs with less down payment, right? That doesn't exist. These were qualified borrowers at the time with low interest rates for all intents and purposes. So it's a valid point. And then you add in trapped equity that's sitting there that people aren't going to walk away from. I don't think it's as big of a doom and gloom scenario as those individuals you mentioned are thinking.
It never was. And when you're not trained to look at economic data or not trained in credit profiles, you just make stuff up. Like I remember in 2006, like the quality of you could break down the debt structures and explain this. But I remember in 2006, somebody came out with 100% option arm loan. And that was like, okay, now you're going into Crazyville. Like you have to create that product to facilitate the ban. You know you're out. It's very boring 30-year fixed loans, fixed low debt costs. That's it. People just want to live in their homes. This is not like the sexy crash sector that people want it to be. And this is why 2020 and 2021 on a historical basis, right? We look at some of these things that never happened because when it breaks down to it, if you're not talking about demographics, if you're not talking about mortgage rates, or you're not talking about credit quality, you really don't know what you're talking about. And this is what the outcome comes to: the biggest whiff ever recorded in U.S. history.
So I want to mention one thing to the people watching, right? I forgot to say this at the beginning. You have the ability down below to input questions. They come through to me, and at the end, we're going to do rapid fire Q&A with Logan as well. So there's a couple questions that have come through already. I'll save those to the end. Hey, let's pivot to a different topic real quick, Logan. So one of the things I think that we hear from a lot of our business partners, and look, I think everybody's just, you go out to a party, if somebody knows you're in the mortgage industry, they want to talk to you about rates, right? So give me kind of an insight on what you're looking at. Like I've seen stuff, I even think in talking to you, that there's a trajectory of rates to a certain point, and then there may be this ability to kind of pull back. What's the realization of that from your perspective, from the data?
So the AB economic model that I wrote for HousingWire last April 7th said that we're going to get the 10-year yield to back up to 1%, right? So mortgage rates weren't priced properly during the crisis. They should have been lower. Now, whether brokers wanted or lenders wanted to keep the margin, or the 10-year yield there was a mortgage market meltdown, EPO risk, whatever it was, mortgage rates were never priced properly. So the 10-year yield got up while mortgage rates were still trending down past August. And I always said after September 30th, we should get better pricing in relationship to the 10-year yield. So the 10-year yield got there. Now mortgage rates in itself, I talked about when the America is back, the 10-year yield will create a range about 1.33 to 1.60. We're looking at, roughly, 3 to 3.375, around there for mortgage rates. We've already established that this year. That was really the main call for 2021 that I did last year. Then it's like, well, the U.S. economic data looks crazily good. Like, manufacturing data, retail sales, home, they all look like where the 10-year yield should be north of 2.42%, which means mortgage rates should be over 4.25%. I peaked out my 10-year yield forecast of 1.94% just because COVID is still here. But if you look at the economic data, bond yields are behind the curve. And a lot of this has to do, COVID is still here. We're not running at anywhere near full capacity. The world is behind us still, right? So they're not running at full capacity. When that happens, there's no reason why the 10-year yield should be this low. It should be a little bit higher. Now, I've always capped out my 10-year yield forecast at 3%. I don't believe we're a super fast economy. We can create inflation like we used to. So that's going to be the cap. But we have all this fiscal stimulus that's going to happen pretty much next year, right? But by the time they approve this or anything, so if there was ever a time where mortgage rates can briefly go above 5% and then come back down, it would be because of that, because we've never really fiscally stimulated the economy when things are normal. We've given a lot of money during disaster relief. Disaster relief are transfer payments, right? So basically, it can't create inflation. You're just replacing income. And what you see is that a lot of the checks, savings rates have exploded, right? People just can't spend that money fast enough. A lot of things are vacations. You can't really go full out, even myself. But once the vaccine things were done, boy, I locked in 3 of my vacations already, good to go. So that savings rate will naturally fall down. But if there ever was a thesis where mortgage rates could possibly go over 5%, very, very, for not a long time, it would be that. That's more of a 2022 story. By that time, where everyone is mostly vaccinated, were starting to become normal again, and then we could take data on in a more traditional fashion. So rates look exactly where I thought it should be, but right now still the 10-year yield is below where the economic data is, and at some point that does catch up and bond yields should rise and mortgage rates should rise. And that's a positive. Like whenever, for like since last August, every time the 10-year yield goes up, I put an American flag and a muscle symbol on my Twitter account every time. And everyone's like, no, we're still in a recession. So you guys are behind the curve. The recession really ended in April. We're all coming back. This is a very unique economic situation, and majority of the people missed it. Why? Because they don't believe in economic models.
It's funny when you take the emotion out of it, you just look at data, right? Like it doesn't lie. But let me ask you this question, right? Because you're talking a lot about data, and I think a lot of people on the surface will look at data in reports, things that you put out for the HousingWire, and then they try to establish what they believe to be like a trend going forward, right? And I wonder where your thoughts lie, because I think while it may not have lasted long, like you were talking about, hey, we were out of it in April, right? But the lingering effects of the pandemic, I think, bring some things to the equation. What's your kind of thought as you go forward, looking at like trying to extrapolate a trend coming out of the pandemic?
You know, there's a tweet I did, I think it was April and May, and I said, roaring 20s are coming, right? And because we provided so much disaster relief, we have excess savings, right? When you have excess savings and you have a prime age labor force that's growing, other countries don't have this, the economy is going to grow. And then on top of that, you're going to do stimulus, which means that at some point, because the baby boomers are leaving the workforce, there's going to be so much job openings out there that you could have maybe a fight for labor at some point. We're not there yet, of course. We have to open up the economy to get everyone back, because the demand for labor is like we're already at pre-pandemic job openings per the recent data. So it just has to open up, and we'll be okay, right? We just had the longest economic and job expansion ever recorded in history, because the U.S. is a very unique service sector economy that does not need big domestic investment to actually have an economy expanding, right? And now we're actually going to do domestic investment, plus the consumers are going to be fine. But in regardings with housing, this is how, like, one way I could explain it on a longer term view. I always look at housing post 1996, right? I actually don't even care about the data previous. 1996, we had another layer of mortgage rates go down, and prime age labor force, population growth. It's very rare post 1996 to have under 4 million existing home sales, right? We always have these 4 million kind of mortgage buyers, new and existing homes together. The only time it really happened was in 2008. 2008 was the period where prime age labor force declined. We had credit tighten, and then it quickly come back. Now, there were two other times where we got under 4 million. It was the home buyer tax credit, where we front loaded a lot of demand, and then it crashed right after. That was a terrible idea. Hopefully we don't do that again. And the other time was the 1 month of COVID delay sales, which created a V-shaped recovery. So think of housing as being sticky. That's why I like the term replacement buyers. I don't like saying the word housing boom, because I've got to create a sales demand curve much higher. I don't think that's the case. I just think we're going to be stable in that 6.2 million total home sales with new and existing homes together, not just existing, should be here for years 2020 to 2024. And the question is, when rates go higher, how much does it impact housing? Can the builders actually sell their homes with lumber prices? There's all these different variables to look in. But again, demographics are good, stable, right? Mature economies typically don't have construction booms or economic booms, but coming off of this recession, because we have so much excess savings and we're going to stimulate the economy, we'll be stable. We're early in the economic expansion. Don't do what the kind of economic trolling people on Twitter and CNBC and all those places did. Call for a recession every 7th hour and miss the longest economic and job expansion in history, right? You got to there's certain models to follow with economic cycles. Just know that we're early in this economic expansion.
So, Logan, let me ask you that question. Then, obviously, we try to keep these really quick, short, hitting 45 minutes. We're into like the Q&A. But before we get there, I'd ask you, if you're, John Gibson, the loan officer at, ABC Mortgage, what are, in your opinion, right? What are 1 or 2 or 3 things I should be following, to your point, from like data models, things like that? What would be key things for me to pay attention to?
For any loan officer, realize that when rates go up, you're creating more future supply for refinances, right? And that happened in kind of 2017 to 2018. The 10-year yield rose all the way. We got to 3.24%. We got to 5% mortgage rates. What happened? It created a big supply of future refinances. And I remember I was at a conference November 8th, 2018. Everyone in America said rates were going higher. 50 economists from the Wall Street Journal, every economist that was speaking, I was like, no, the 10-year yield is going to go down next year. We're going to have a one handle. Rates are going down. Everyone's like, no, that's impossible. If you just look at a 40-year chart of that 10-year yield and mortgage rate, right? It doesn't break out. We weren't really pushing our economy too hot. So when that happens, realize that at some point rates will come back down. There's your future supply of refinances. So don't give up on clients. I think a lot of people back then thought, well, rates are going to go higher. And guess what happened? Bam. Rates went lower very fast. You had another wave. And then on top of that, you had the most probably overbought bond economic event ever, where COVID created another layer of rates, and everybody, my father's still in the business. So literally everyone that could refinance then. So just always remember that going out in the future, that when economic data does get better and rates go up, there's your future supply of refinances.
I like how you look at that. People that know me, I try to tend to stay on the positive side of life. I think waking up and looking at everything from one lens, it lets the day and it puts you in the right mood. And I think people worry about rates going up. Well, guess what? If you've been doing this for any period of time, right? Rates are cyclical. They go up, they go down. And guess what? To your point, I think I've never phrased it that way. I've always tried to tell people, hey, make sure you're paying attention to your purchase book of business when you're having your best years, because that tends to be when rates are really low and you're killing it on refis. Don't forget about your book of purchase referrals and business, because when you do and you go back out of it, everybody's doing it at that time.
Yeah, and if you trust me, with the competition now and the technology now, you don't follow through, your clients are going to get snapped up like that. So
yeah, I like how you phrase it. It's a future inventory for refis. There's always going to be a need to refi, even if rates tick up slightly. There's always, we've talked about trapped equity, right? Mm-hmm. If I'm not moving, some people are starting to do construction on their house and tapping into equity. And then look, there's always other things, college education, divorce, insert whatever it is. And then rates will come back down, and people that just purchased in a rising rate environment will be that, backbench and replenish when rates come back down and people are refinancing in the future. Yeah. Okay. One of the questions I know that came through, Logan, let me read it to you. It says, when and how are we going to have to pay the piper, quote unquote, for all the economic stimulus debt from the COVID packages, the stimulus packages, and money spent to sustain the environment that we're in?
Okay. It's always my favorite question. It's a question I've been getting for, I think, 10 years now. I want to apologize to everyone in this country. The Republicans and Democrats and a lot of people have lied to you. Federal debt is not a problem. It is a boogeyman, right? We are the United States of America. There's no federal debt crash. There's no inflation going to break away. The dollar's not worthless. There's no piper to pay. The people that are pushing this are anti-central bank fanatics. They're gold bugs. They have been wrong about America because they hate being alive in this country after 1913. Because every time, every decade, there's the same people that says, we're going to have to pay the piper. The dollar's worthless. So where's the Mexican peso going to go when the dollar's worthless? What's the Japanese yen doing, right? Is Europe going to overtake the US? We are a $140 trillion GDP financial asset country. And what's happened? If you look at the data, federal debt has been rising. Rates have been falling. The rate of growth of inflation has been falling. The velocity of money is not the same. The one time where you can think about inflation, what is inflation? Too many money chasing too few goods, shortages. Where can you see shortages, right? Lumber, you can see shortages. You can see shortages in chips right now because of production. But the notion that the US economy, where the velocity of money is so great, this is a fraudulent grifting tactic that has failed. There's an article I wrote. It's called 71 trillion in debt by 2060. I wrote it in 2019 just to give everyone a heads up. This is going to happen, and this collapse of the United States of America, where Mexico and Japan overtake us, and we're just such a weak country, a third world country, is a fraudulent, grifting, failed tactic by some of the biggest conspiracy theory people post 1913. I give you the gold bugs and the anti-central bank people, who none of them actually really believe this, because their trades are never set up that way either. So don't worry about that. When Mexico collapses and Japan collapses and China collapses and Germany and France, because a lot of their debt to GDPs are different. When that happens, right, then let's talk about the US collapsing. We pay the piper. But that works on the uninitiated. A lot of my work over the years is to try to keep people stay away from that group, right? They have been wrong about America since birth. They will be wrong about America in death. There's no afterlife for them to cry about the Federal Reserve or federal debt. It's not going to happen.
Interesting. And go back real quick. You wrote what article in 2016?
No, 2019. You just type in 71 trillion in debt by 2060, right? So I provide a model to say, hey, guess what? Federal debt's going to rise, and even when I think when the tax cut passed, and they talk about it's going to pay for itself, and that's never going to happen. I even said, listen, this is not going to pay for itself just because older countries have higher debt to GDP nations because they have to give transfer payments. But it's not going to. We're going to have $1 trillion deficit in 2019, and nothing bad's going to happen. We had $1 trillion deficit in 2019. Nothing really bad happened. We would still be in the longest economic and job expansion ever recorded in history if it wasn't for COVID, which was a brief 2-quarter recession. We literally, after April, because albeit we were working from a very deep low, we started to recover. And now look what happened. All this trillions and trillions and trillions of dollars that we spent in the 1950s, all the way up to here, the dollar is a reserve currency. Mexico is not going to overtake us. Japan's not going to overtake us. China's not going to overtake us. China's prime age labor force growth peaked. It's going down. We are going to flex our American muscle for the next 3 decades. And everyone who thinks the piper is going to be paid, they're going to go to the afterlife. Nothing's going to happen, right? Until all those other countries collapse first. Because I tell you, I'll take the US over Europe, over Japan, over Mexico, over Brazil, any day of the week, because we are the most powerful, unique economy in the world, and we have the demographics, and they don't.
Valid points. Hey, you mentioned, the question popped up when you mentioned something around construction and materials, so I wanted to kind of ask you and get your opinion on it. I'll kind of paraphrase it. It was around new construction, delay in materials, cost to build. Builders are starting to look at more things like contracts plus cost so they can lock in, some type of profitability. What's kind of your thoughts around that as we move forward around the supply and short lack thereof it?
The builders are going to run into a problem at some point when mortgage rates rise. Now, one of the things I've talked about with new home sales is that if you really want to track if builders are doing bad, monthly home sales supply. On a 3-month average, if it's below 4.3 months, the builders are great. So we had this really big spike in lumber, and the builders' confidence index is near all-time highs. Why? Because all the builders care about is demand. So as long as monthly supply is below 4.3 months, life is great for them. Once it's 4.4 to 6.4 months, it's okay. That was the previous expansion from 2008 to 2019. It was just okay. It was the weakest new home sales cycle ever recorded in history, but it's all right. You can keep construction going. Once you get above 6.5 months, builders are pulling back, right? In 2018, that happened. Supposedly, we had this record-breaking demand and we had to build more homes. As soon as monthly supply got above 6.5 months, that's kind of my rule of thumb. Oh, guess what? One of the builder CEOs said, it's the worst fourth quarter in history or since the Great Recession. So remember, builders do not oversupply a market. They're here to make money. We're never going to build enough homes if we allow the private sector to do it because they're here to make money. So at some point when mortgage rates do rise, because new home sales are no longer working from the very low bar that they've had to enjoy, they will get impacted because guess what? Guess who their competitor is? This massive existing home sale market, which dwarfs them geographically or all around the country, and they provide cheaper homes. So it's weird. This sector actually supplies soldiers that are eventually going to fight them in the future. And this is one of the reasons why I do not believe in a construction boom in the US or why housing starts will never be as be as big as people think about. I mean, even now when we think, well, there's going to be $213 billion for housing. Well, we're going to build 100,000 homes. There's 140 million units already. That's like a tennis ball into the ocean, right? So mature economies do not have construction booms, primarily because the government would have to deficit finance all of that. And let's be honest, everyone loves home prices being high, right? Everyone says, oh, well, home prices have to come. And no, everyone, the homeowners, the people who buy homes love prices high. And, they're going to fight tooth and nail to keep their neighborhoods as minimal as possible. And renters don't vote. So they talk about a lot of things, but in scale, it just can't happen. Over time, I hate to say this because people rip on me, the baby boomers will die off, right? That's how nature works, right? They don't take their homes with them. So at some point, there are going to be supply passed down. It's not a silver tsunami. Silver tsunami was a marketing gimmick that in 2015, every baby boomer was going to sell their house in 1 month and their home prices were going to crash. Man, these people are terrible, man. I can't tell you. But eventually, that's what's going to happen. The builders know this. They might not say it publicly, so they just build off of their demand curve, right? So as long as new home sales are growing, they're okay. At some point, that's going to hit, right? Mortgage rates will impact that sector first. So as long as lumber prices are this high, they are the most vulnerable sector of the economy because their competition just provides cheaper homes than they do.
Well, hey, Logan, we could keep this going, but I want to be mindful of everybody's time, your time especially. So anything, words of wisdom, things to look out for, key points that you would want to share with the loan officers that are out there with us today?
Be careful of overhyping of inflation and mortgage rates going to 6, 7, 8, 9%. Always follow people that have economic models that can show you historical trends of something. The world we live in, awards trash a lot, especially on the internet and TV. So if you care about the truth, right, I always say, be the detective, not the troll. A lot of people don't want to be the detective because it's boring. If you want to know about like where things are going, follow people that have economic models. Everybody's going to be different. I'm different than any of my economist friends on like that. But if that's what you care about, which I think a lot of people don't, but if it is, follow data, follow trends. Demographics matter, productivity matters. All the other stuff is like Mickey Mouse, ideological, right? So don't be like the people in the past that said inflation's going to go rampant. QE1 and QE2, QE3, we're just longest expansion in history. We're early in the expansion now. There are things to track. People like myself and others, we don't care about that ideological stuff. We just want to get the data and the economic trends right.
Well, hey, Logan, a lot of good stuff in a very quick time period. I love Be the Detective. I think that's a great slogan for this segment. And we can't thank you enough for spending some time with us today. So really appreciate it. Thanks for all the info.
Pleasure to be here.
Awesome. All right, gang. Hey, so a lot of good info. You'll get the recording to this so you can go back through it. I think Logan had a lot of good insight and certainly some of his own perspective on things that we look at in this industry on a daily basis and how it may or may not impact us. So hopefully you got some good information out of this one. Again, can't say thank you enough for taking the time out of your schedule to be with us today. And then I would tell you, like usual, and we can bring up kind of what our next segment's going to be. Again, second Thursday of every month from 2 to 2:45-ish. And we're trying to bring different speakers, topics to you that we think are relevant at the time. So as the slide comes up, you'll see next month, it will be all things government lending. And that's coming up now. There you go. So it's May 13th, 2 p.m. We're going to have our own SVP of TPO risk, but more importantly, everything from a government credit risk, you name it, his hands are in government lending. Angela Ray from Flagstar will do a quick session on all you need to know about the state of the union when it comes to government lending and what maybe, clarify some, what the future may hold. And obviously with some changes from an administration perspective, what we can, potentially see coming down the road or what's in store for us from a government perspective. So again, can't say thank you enough. Stay safe. And we'll catch you next time. Have a great day.